Hi, sir. Good to be speaking with you. Thanks so much for making time and speaking with us. To begin with, talk to me about how the overall disbursements are in Q3 like, because if we go by the retail data which is coming out with respect to the auto sales, festive sales, etc., it hasn't really matched up to the expectation. Would you reckon that Q3 has worked out to be a bit more tepid versus your internal estimates, or it's on course as to what you expected, how it's going to pan out?
In Q3, October, we saw a good spurt in disbursement, primarily because both the festivals fell in that month. November had a little bit of a drop compared to October, but it has been better than even the earlier months, which were in H1. December, we expect it to have a better, higher disbursements because again, it's a quarter close and there will be year-end closure discounts, etc., offered by manufacturers. So we expect the disbursements to be better in December. Overall, Q3, we should see a better quarter as compared to Q3 of last year.
Expecting it to be a better Q3 than what we saw last year, but help me with the numbers with respect to the guidance so far. I mean, you've been tracking, I think, disbursement growth of around 10 to 15% on a year-on-year basis. What's the expectation? How you're likely to end this year, and is the pace likely to accelerate in Q4 further?
Disbursements will accelerate a bit more in Q4. It will be around these numbers. AUM growth would be in the range of around 25% is what we are, right now targeting.
The latest coming in with respect to the AUM growth and all of that, but within the various segments that you have for yourself, right from of course vehicle financing to loan against property, home loan, SME, and all of that, even consumer and small enterprises, is it fair to say that vehicle finance and loan against property is something which will see the largest amount of growth, given most of the companies are slowing down when it comes to disbursements related to unsecured lending or SMEs and the other smaller pockets?
Yeah, but for us, vehicle finance, loan against property, and home loans are the three larger proportion of the assets, and these will continue to show growth in the same pace as it was doing in H1, with a bit more thrust on the vehicle finance because it had its shortfalls in Q2, primarily because of inauspicious months, delay in harvest, as well as continuing rainfalls. We saw that turnaround a bit in Q3, and we expect this trend to continue in Q4 now that harvesting has started and we see traction at the in the rural segment, which is where our focus is with regard to vehicle finance. LAP and home loans are also showing good traction, primarily because we have gone into geographical expansion and we are seeing good growth in the geographies where we have started to introduce these products. Yes, CSEL will be around the similar levels. SME will also be at similar levels. SBPL will show growth, but that is a very small portfolio right now, and so that growth would not significantly impact the overall company growth numbers.
When you talked about the recovery when it comes to the rural end of the market and of course vehicle financing, which is your mainstay, but correct me if I'm wrong, analysts were worried about a bit of a slowdown when it comes to MHCV segment. Has that turned around, you would say?
No, MHCVs are still slow, but our focus on MHCV has been moderate, and we are especially in rural, it is more of lights and mini lights as well as passenger cars. So we see that traction coming, and also there has been a good traction in used segment. So between these two, we will be able to reach our targeted growth.
Mr. Selvan, a question as far as net interest margins is concerned as well, because the overall system liquidity expected to improve on CRR basis. It might not directly have an impact on NBFCs, but the system liquidity shall improve. What's your sense as to what could be the added benefit to your NIMs? Because if I have it right, in earlier conversations, you talked about the possibility of 10 bips improvement. Does that become 13 to 15 now?
No, it would be at similar levels. So let us keep our expectations low. Better to promise less and deliver better. The NIMs will remain at similar levels as what we saw, with marginal improvements because, as you rightly pointed out, the CRR improvement would not immediately impact the NBFC. So we will see that traction coming in as market pricing improves in the coming quarter.
Fair enough. Now, given that the recent CRISIL report has spoken about NBFC's AUM growth moderating around 15 to 17% in FY25 and 26, from a stronger growth that we've witnessed in FY24 of close to 23%, what would be the outlook? Do you think that you will maintain that guidance that you spoke about the last time, 25 to 28% in the second half?
Yeah, we are still targeting 25 to 28% growth, but I think because of the environment, we may be on the lower end of that, segment of the target, which will be under 25% growth. So we will still reach the 25% growth, and we see the same traction happening in FY26 also.
And how are you looking at the metric when it comes to your cost of funds and impacting your yields?
So cost of funds would remain at similar levels.
Snapped that line. But nonetheless, the management of Chola Finance talking about how they are aiming for a 25% AUM growth in Q4. Net interest margins will be at around the same level. A marginal uptick is what they're saying, but they have acknowledged the MHCV segment continuing to slow down. Mr. Selvan, we've got you right back. Can you go ahead and talk about what you were saying?
Yeah, sorry about that. Yes, that NIMs would improve marginally, but especially in the context of this ARR cut that would impact market borrowings. And it would also, we also expect at some point in the coming quarters, we should see some repo rate cuts, which should also improve our NIMs.
Appreciate your time. Thank you so much for giving us that clarity on some of the financial metrics as well as what the outlook is going forward. Well, it's the stock up to holding out by about 3.5% in trade. Tell you what, we'll slip into a very quick break right here on the show with news that we're continuing to lay low for the frontline indices.